Imagine paying for your house twice. That is what happens to many people who take out a mortgage to buy a home without understanding amortization and how it works. This video will show how interest and principal behave over time, and how changes in your interest or loan amount can save you six figures or more over the life of a loan. Amortization is paying off a loan over time with a consistent payment split up between interest and principal. On a fixed-rate mortgage, the payment stays the same, but how it is allocated changes over the life of the loan, with early payments mostly going to interest and later payments mostly going to principal. Before buying a home, it is important to understand an amortization table and how it works. For our first example, we will take a 30-year fixed-rate mortgage for $600,000 at 8% interest. You can see in this example the payment not accounting for escrow is just over $4,400 a month. If we look down at the amortization table, you can see roughly $4,000 is allocated to interest for the first payment, and only a few $100s is going to principal. But with each payment, the interest payment slightly decreases and the principal payment slightly increases. By the end of the 30-year loan, totaling 360 payments, a majority of the payment will be allocated towards principal. Another way to look at this is if you look at the line chart in the upper right-hand corner. Here you can see the green line, which is your interest starting high and falling, while the red principal line starts low and rises, intersecting at payment 257. In other words, until those lines cross over, the bank gets most of each payment because it is mainly allocated to interest. The pie chart below is the most helpful chart for seeing loan lifetime payment amount and how it is broken up between interest and principal. In this example, you could see all payments total nearly $1.6 million. Of that, about $600,000 is principal and close to $1 million is interest, so you pay back your loan plus about $985,000 for borrowing the money. Now let's change the interest rate to 6% and keep $600,000 for 30 years. The payment falls to about $3,600, and the interest slice of the pie chart shrinks. Over the life of the loan, that 2-point drop saves well over $200,000 in interest. Same house, same loan amount and term, just a different rate, and the total cost changes massively. Next, let's change only the loan amount. We'll take the rate back to 8%, keep 30 years, but cut the loan from $600,000 to $400,000. And after doing this, you can see that the payment drops to just under $3,000. The pattern of interest to principal is the same shape, but every number is smaller because you borrowed less. So lifetime interest is far lower at about $660,000. This example illustrates that a $200,000 change in loan amount at 8% interest is actually saving you roughly $325,000. For our last scenario, we will change the loan to be $400,000 at 6% for 30 years. You can see the payment falls again to about $2,400. Here the interest slice is the smallest of all at only about $465,000. This example shows us that by lowering both the rate and the amount you borrow, you save a huge amount of money. These four scenarios highlight three big ideas. The first, fixed rate payments are front-loaded with interest, which makes the early years brutally expensive. In every example, the first rows of the schedule are mostly interest, and only later do the principal portions catch up. The second point is, even a small rate change has a large effect on total interest over the life of the loan. Comparing $600,000 at 8% to $600,000 at 6%, you saw how just a 2-point drop/lifetime interest by hundreds of thousands of dollars without changing the loan amount. Third, borrowing less through a bigger down payment or a slightly cheaper home can cut lifetime interest substantially. The $400,000 scenarios clearly produced far less total interest than the $600,000 scenarios at the same rate. All of this to say, understanding amortization gives you real leverage when deciding how much to borrow, which term to choose, when to refinance, and how powerful extra principal payments can be. With a good amortization tracker, you can run these what-if scenarios in minutes and see exactly how many years and how many dollars of interest you can cut from your mortgage. The exact Excel I used in this video is available at excelexchange.org for only $5. The link is in the description of this video. It will allow you to test what-if scenarios in seconds to see the amortization table, the split of principal versus interest, and the total lifetime payments of a loan. It is a great tool that I strongly suggest you use before buying a home.